Chapter 8, Other Areas in Financial Services. Although the fundamental building blocks remain pretty much the same, financial services sector is constantly evolving. So what they're saying here, the building blocks of financial services is, you can either say it's saving versus borrowing, which we call financial intermediation. It can be buying versus selling, which we call securities trading. It can be it can be risk management, like insurance and derivatives. The fundamentals of financial services are basically the same for a very long time. The products do evolve and change, either according to demand, according to requirements from regulators, according to markets. It is vital for anyone working in or aspire to work in the sector to keep pace with these changes by scanning the news for important developments. So, I mean, if somebody was in a coma in the early 90s, which sounds like very recent, but it's not, and he wakes up today and we look at him and say, hey, look, let's invest in this ETF that invests in Bitcoin. Even if he was the most professional financial investor in the 80s and the early 90s, if you say ETF and Bitcoin in the same sentence, he's not going to understand anything. So it's very important for anybody working in the area to constantly read. I'm not a big fan of TV, so I don't watch TV. I don't watch news TV, but we do listen. We do read newspapers. We do read news. We do listen to podcasts. So whatever your favorite method of consuming news, it's important that finance should be one of those areas that you constantly listen to. At the time of writing, there are some major political developments, like Donald Trump's difficulties in implementing his election pledges after midterm elections that resulted in the Democrats dominating the House of Representatives, and the challenges in implementing the decision for the UK to leave the European Union. So this is, I think, 2 years old. So obviously, President Biden took over yesterday. This is still talking about implementing election decisions and the UK leaving the European Union. In the US, Donald Trump may or may not get the funding for his wall. So this is so old now. Between the US and Mexico, because that was one of his promises. Not only will there be a wall between America and Mexico, Mexico is going to pay for it. At least that was the promise. And any increased government spending will have an inevitable impact on US borrowing. Brexit, which is the exit of Britain from European Union, may result in some financial services it's definitely going to result, because the UK left at the beginning of this year on January 1st, and they've already started to feel the pinch. Moving away from London and create more powerful financial centers in Europe, such as Paris and Frankfurt. But luckily, CISI did not go into much politics in this chapter, because it's finance and it's for beginners. So away from politics, thankfully, there is ongoing development of technology that is seeing more and more automation, particularly in the area of investment with so-called robo-advisors. Technology companies, we are actually working on a robo-advisor here at Tadawul. We are building an algorithm that will build a portfolio based on certain risk profiles. Technology companies also continue to make inroads in areas of finance that are traditionally the preserve of the banks, such as the growing importance of smartphone payments. I mean, one of the fastest growing smartphone payments countries in the world is Kenya. They have a system where you can pay with your phone, with the NFC. So the technological advancement and financial improvements and involvement isn't just limited to first world countries or to rich countries. If something is convenient and cheap and can be made available to the masses, everybody's going to use them. In this final chapter of the book, 4 areas will be explored in more details: fund management, foreign exchange, insurance, financial planning, especially retirement planning and pensions. So let's talk a bit about each one of these 4 quickly, and then we will discuss them in detail. Fund management is where a firm creates an investment fund, which is basically a sort of an account where a group of people transfer the money, they invest together into that account, and the fund manager will take that money and invest it. So an investment fund for its clients, which will enable these clients to invest together, sharing in any gains made or losses suffered. The investment decisions will be made by the fund management firm, the company which established the fund, who invited the investors. They will be making the investments and they will be making the decisions on the investments. The second area is foreign exchange, which we did cover a little bit, I think, in the first few chapters. Is a result of international trade or international travel. The money held by one party needs to be exchanged into another currency before a transaction can be completed. And that's why foreign currency transactions are quoted in pairs, like, let's say, USD GBP. Insurance is the third method, is a method of managing risk. We said insurance, we also mentioned something about also derivatives can be used to manage risk. Derivatives can be used to manage risk through hedging. We use derivative contracts to hedge, and hedge means reduce risk. For example, an individual may suffer from a serious illness that needs medical attention. An insurance company may be required to pay for that treatment under a health insurance policy. And it's not just health insurance, of course. You've got marine insurance, you've got car insurance, you've got life insurance with its different types. In business, you've got professional indemnity insurance, you've got key person insurance, you've got shareholder insurance. Financial planning is providing assistance to individuals, their families, and businesses in organizing their financial affairs to achieve their financial and lifestyle objectives. That's financial planning. It usually involves planning your saving, your borrowing, your investments, your future, your retirement, your inheritance when you're dead, your will, your taxes. Within this, retirement planning is particularly important to individuals saving for the time of life when they will be no longer working. Pensions, retirement. They will have to manage without earning a salary. So that was the quick introduction on the 4 areas that we're going to cover in this chapter. We will start with the first one, which is fund management. So what is fund management? This is when a firm gives its clients the opportunity to invest in a fund, which is an amalgamation, a grouping, a gathering of all clients' invested money. So you can have an account. So this is a fund. And you've got this individual, you've got this individual, and then this individual, and then this individual. All of them will be putting money into this fund. So this fund will have lots of money in it. And then they've got a fund manager, which is usually the company who established that fund. The fund manager will take that money and go invest it in property or gold or stocks. So these investments that the fund manager invests in, obviously they're going to make a return. And that profit, that return is distributed among all of these investors. Because they all put their money together into that fund, they all have the right towards or to the profits and the income of that fund. The fund's investments will be chosen by the firm, and the client investors will share in any gains or losses generated. This can be described as a collective investment. Collective means group. Since it's a group of individuals invested in a fund, all funds have a group of individuals because they are investing together. And the fund can be termed as a scheme. So thereby we call it a collective investment scheme, a CIS. Yes, we can sometimes call them funds, but not all CIS are funds. Some CIS or collective investment schemes are funds, some of them are contracts. So the logic and the features are best illustrated by looking at an example. Let's see the example that CISI gives us. Mohammed is a recent graduate with a good job. He is smart, but knows very little about investments. And he has been told it will be sensible to invest a modest amount of around $100 per month into equities, hopefully to enable him to afford a house one day. So he has a goal, and that goal is to buy a house. He particularly likes shares in technology companies as he feels technology is the future. He could choose and then buy equities, the stocks himself, and this is called direct investment. Why might that be a good or bad idea? Now, well, if you buy the stocks directly, then you are the owner of these stocks, and if they distribute dividend, you get these dividends immediately, and you don't have to pay any fund manager any fees. But the bad side of this is you are not diversified. So if Apple does badly or any company does badly, you will lose a lot of money. Also, Apple might not be the right investment for you. So investing directly into an asset can be both good or bad. Assume Apple is trading at a price of $150 per share. Google is trading at $1,080 per share, and Microsoft at $105 per share, and Facebook at $147 per share. So with $100 only, Mohammed cannot afford to buy any of these shares. He would have to wait for 2 months before he has sufficient cash to buy a single share of Microsoft, or a single share of Facebook, or a single share of Apple. But if he wants to invest in Google, he will have to wait 11 months. And that is assuming that the prices don't go up. So if the prices go up, he will need to wait for a longer period of time. So this may be bad news on two fronts for Mohammed. The first bad news is that he will have to wait before buying any of these shares. But ideally, he would like to put some money in all of these companies, because common sense tells Mohammed he is better off spreading his investment around. That way, if one of the shares does not perform well, like for example, let's say Google, he would still be fine because he's invested in Apple, Microsoft, and Facebook, in addition to Google. So this will be hopefully compensated by another of the shares doing well. And this very term is what we call in finance diversification, which is spreading your investments across multiple stocks, multiple geographies, multiple sectors, sometimes multiple assets. So not just stocks. You invest in stocks, bonds, property, gold, and so forth. So if you are investing directly, it's very difficult for you to diversify because you will need big capital, thousands or tens of thousands of dollars to diversify. But if you're investing in a fund, you don't need tens of thousands of dollars. If you just invest in one share in a fund or one unit, $100 or $200, that money is spread across all of the investments in the fund. Funds allow you to diversify easily and cheaply. So that's the first problem with investing directly. He would have to wait to get enough money to buy one of these shares. The second problem is that Mohammed is not really the person best placed to decide which of these technology companies to buy. Does he have experience or knowledge in investments? No, he doesn't. So how can he be sure that buying Facebook and Amazon is the right thing to do? Not always hearing things in the news means that that's a good thing. So he doesn't have the knowledge or the experience to buy them directly. He is only considering these 4 companies because he has heard of them. There may be many more promising technology companies available that he knows nothing about. So these difficulties, not just that, I mean, even if you're looking at, for example, costs, if you're looking to invest in property, of course, buying property involves lots of tax and costs. If you are buying it directly, you will have to pay for all of these costs by yourself, and you will need big capital to buy a property yourself. But if you invest in a fund which invests in property, then the cost of buying that property is distributed among all investors, so you will only pay a fraction. And also, you might not know the best property to buy, but if you put your money in a fund, the fund manager, who is a property professional, he will find the best property to invest in, thereby guaranteeing you a higher possible return. All of the difficulties highlighted in the example can be addressed if Muhammad were to invest in a fund rather than directly. So the 2 problems that we covered is that 1, he doesn't have enough money to buy shares directly, so that can be solved by investing in a fund. Because usually the price of fund units or shares are cheaper than many stocks. The second issue, but before we get into the second issue, let's just talk about the first one in detail. Investing in a fund is described as indirect investment because if you buy an investment directly, if you buy a property directly, or if you buy shares yourself, we call this direct investment. But if you invest in a fund, well, you'll give your money to a fund and the fund is going to buy this property. We call this indirect investment. Don't forget, funds are types of collective investment schemes. So investing in a fund is described as an indirect investment because the investor invests in the fund and then the fund invests in the shares. So even though you might not own the shares directly or the property directly, you own the fund who owns the property. It's like running a business and the business has a van. Although the van is not in your name, but the business is in your name. So you own the business and the business owns the van. So the benefit of that van goes to the business, which ultimately goes to you. The first issue for Muhammad was that he had to wait 2 months to buy any shares because of the modest sums he was planning to invest, $100. And even then, could only buy into one of the 3 companies with shares cheap enough: Apple, Microsoft, or Facebook. That means he couldn't invest in Google. This would have stopped him from benefiting from diversification because he would only be able to buy 1 share. And that's bad. You're not diversified. Diversification is simply the technical term for not putting all of your eggs in one basket. The more companies' shares held, the more likely that it's surprising bad news in one company is offset by surprising good news in another. In other CISI qualifications, you will learn that investing in single investments involves issuer risk. I think we covered it in one of the chapters. Issuer risk is the risk that one of these issuers of stocks or bonds might fail, thereby causing your shares or investments to lose value. So If you're only invested in one company, then and that company fails, you've lost all of your capital. But if you are investing in multiple companies, some people say diversification should be at least 30 stocks of different sectors and geographical regions. That's what some professionals say. Some other professionals say 20 is enough. Well, everybody has an opinion. But yes, diversifying reduces your issuer risk. You will learn that issuer risk is also sometimes called unsystematic risk. So diversification allows you to reduce your issuer risk or your unsystematic risk. Diversification is a key advantage of a fund because the fund is gathering together lots of individual investments and therefore is able to invest larger sums of money in a variety of different company shares. Well, because when Muhammad puts his money in a fund, even though he is putting only $100, this fund is invested in thousands of different shares. So that $100 is distributed among these thousands of shares. How? This $100 is actually part of $10 million, which this fund has gathered from thousands of different investors around the world or in the region. When all of these people put their money, the fund manager now has $10 million, and the fund manager is able to buy all of these different types of shares. So when Muhammad puts his money, his little $100 into the fund, it actually joins the 10 million and is distributed among these big number of different shares. So if Muhammad were to invest his money in a technology fund, he would begin to solve his diversification issues. It would only begin to solve the diversification issues because his portfolio could be further diversified. How? So instead of just putting it in this fund, Fund A, which is fund for technology companies, he could also put it in Fund B, which is a fund for real estate, Fund C, which is a fund for financial services companies, Fund D, which is a fund for hospitality companies, Fund E, which is a fund for different other sectors. So investing in a fund is a good thing, but he is investing in a technology fund. So this is a fund which only invests in technology companies. So any bad news affecting the technological sector, the whole fund will struggle. But if he's invested in multiple funds across multiple sectors, yes, that's true diversification. So investing in a technology fund, this could only begin to solve diversification issues because his portfolio could be further diversified by not confining his investments to just technology companies. Instead, broadening his investments to include shares in companies in other sectors like pharmaceuticals, banks, industrials, oil and gas, media, and food. You can have funds for each one of these sectors, and you can have one fund which covers all of these sectors together. After all, a negative event occurs within a particular industry. For example, the technology sector generally suffers due to concerns about exploitation by terrorist organizations or poor defenses against cyber attacks. It might be countered by positive events in other sectors, such as an increase in the price of oil. That's why whenever you're building a portfolio, you need to be diversified across multiple sectors. Investing in a fund would also deal with Muhammad's problem that the money he has to invest is not large enough to buy a single share. In Google or Apple, the size of the fund and the way it's structured enables investors like Muhammad, we call them retail investors, to buy a portion of the fund for a modest amount of money, as shown overleaf. So let's look quickly at this example. The Apple and Alphabet Fund. Of course, Alphabet is the parent of Google. So a fund manager has set up a fund. He created this fund to invest in the best value technology companies. and advertises for investors. Each investor is only asked to invest $100. The fund manager attracts 1,000 investors, a total of $100,000. So this is the Apple and Alphabet fund. So it has 1,000 investors. Sorry about this guy, his neck is broken. He's got thousands of investors, and each of these investors is investing $100. So this fund now has $100,000 to invest in Apple and Alphabet. The fund manager feels that the current best value shares are those of Apple and Alphabet, the listed company that owns Google. Alphabet owns Google. He feels slightly more positive about Apple and uses the money to buy 443 Apple shares, consisting of $150 each. And he buys 31 apples of Alphabet, Google, consisting of $1,000 each. The remaining money in the fund is kept on deposit for the moment, ready to spend when the right opportunity arises. Usually, fund managers keep a certain money aside in case they got an opportunity, like a company which is suddenly cheaper to buy, they step in and then use some of that money to buy. So, the fund's investments are as follows. Each investor's $100 is now invested in Apple and Alphabet, despite the fact that one individual Apple or Alphabet share is too expensive for $100. Assuming Mohammed uses $100 to invest in the fund, he would now own 1,000th of a fund because he owns one share of 1,000 shares. Remember, there are 1,000 shares, each share for $100, and he put only $100. So he owns 1 out of 1,000, which effectively means he has 44% of an Apple share and 3.1% of an Alphabet share, plus a little bit of cash. Because this fund, which has $100,000 in cash, in money, it invested in 443 shares of Apple. Each one cost $150. So out of the 100,000, 66,000 went into Apple, and 33,000 went into Alphabet, into Google, and $70 were kept in cash. So 66% of the stock is in Apple, and 33% of the stock is in Alphabet. This means of the $100 that Mohammed invested, 66% of that fund, of that money went into Apple, and 33% of that money went into Alphabet. The fund has essentially allowed Mohammed and other 999 investors to purchase a part or a portion of Google and Apple. So, if this fund invested 66,450 in Apple and 33,000 in Alphabet out of the 100,000 in total, and Mohammed had $100 of that 100,000, that means of this $100, $66 went into Apple and $33 went into Alphabet. The final issue that Mohammed faced was a lack of expertise. So he knows he wants to invest in technology companies, but he doesn't really know which technology companies. He has heard of Apple and Microsoft and Google, but those are not necessarily the only technology companies available. There might be others, which might also present a good investment opportunity for him. He knows very little about the variety of technology companies available, and he has a difficulty assessing which companies are likely to do better. He hasn't learned financial analysis, he hasn't learned fundamental and technical analysis, so he doesn't know which company to buy. Also, he doesn't know how much to put in every company. He doesn't know how to allocate his investments. So, this again can be solved by investing in a fund. All he has to do is put his $100 in the fund, and the fund manager, who is an expert in investments, and asset allocation, he will distribute his money across these different assets. He will find the best technology companies, and he will distribute the money as he sees fit. The technology funds that are made available by the fund management firms are run by professionals who are constantly monitoring all of the technology companies and assessing which companies are the best investments. They know more about the market than we as individuals do. Each fund, of course, is likely to invest in considerably more than just two companies. Now, our fund is in Apple and in Alphabet, but usually funds invest in hundreds of different shares, sometimes thousands of different shares. We end the fund management section with a quick summary. In summary, using a fund rather than directly investing will result in the following benefits. 1. Money from a variety of investors is pulled together into a single fund. That's why we call it a collective investment scheme, because it takes the collective investments of a group of people. 2. It will enable the fund to benefit from diversification that might not be available to individual direct investors. As a direct investor, if you have $1 million, you might only be able to buy one property. But if you put it in a fund and that fund has $100 million, then that fund can buy 100 different types of property. They can diversify. You can't. 3. The fund investors are effectively able to buy portions of individual shares. 4. The fund is run by a professional fund manager who has the experience and the knowledge to invest and get us stronger investments. I mean, you can be knowledgeable and experienced, but fund managers are professionals. They've been doing this for a very long time. So let's continue with chapter 8. And let's talk about foreign exchange. We did talk a little bit about foreign exchange in chapter 2. We quickly introduced the concept. We are going to expand on this just a little bit more. Foreign exchange, or Forex, or FX, is an integral part of many business transactions. Very rarely would you find these days a business which only transacts in its local currency. It's also part of personal transactions when international travel is involved. The smaller part of foreign exchange market involves individuals traveling abroad, perhaps for holidays, as detailed in the example below. The majority of foreign exchange transactions that are happening around the world are mainly between banks, international banking, commercial banking are the biggest players. They dominate foreign exchange transactions around the world. Individuals traveling abroad for holidays are a very small part of foreign exchange. So let's look at a quick example. Hussein is visiting London for a short break. He's normally based in America, and all of his money are in US dollars. He knows he will need some pound sterling to pay for the taxes, the buses, the food, and the entertainment. He draws a lot of US dollars out of his US bank account, and he sells them for UK sterling at the foreign exchange dealer's kiosk at the airport. Big mistake to exchange at the airport, but this is not the point of our conversation today, right? Hussein has entered into a currency trade because he has sold the US dollars for the UK pound sterling. The amount of UK sterling that Hussein receives at the kiosk will be determined by the prevailing exchange rate between US dollars and UK sterling on that day. Of course, the exchange house or exchange bureau is going to add their own profit or spread. And before we continue, just a reminder that in order for you to receive your attendance certificates, you will need to complete the feedback form on our portal. Please do that today so that you can get your certificate next week. The certificates will be sent to your HR department. Now, the quoted rates might be as follows. Dollars per pound. So for every £1, you will get $1.2, $1.25 or 1.35. So the exchange house will buy from you at 1.25, or they will sell to you at 1.35. So that's why we call this, let me just cover these quickly. That's why on the left side, this is always the buy price or the bid price, and the offer or the sell price for the bank or for the currency house. And if you have dollars and you want to get pounds, you will get, for every dollar, you will get 0.74 pound. This is the price at which the exchange house is buying, and this is the price at which they are selling to you. So you can see there are actually two sets of codes, whether you're holding dollars or you're holding pounds. The first is for the number of US dollars you will get per pound. So if you have pound in your hand and you want US dollars, this is what you will get. The second is for the number of pounds per dollar. So this is where you have dollars and you want to get pounds. Which of the two rates will be highlighted by the kiosk assistant for Hussein? Keeping in mind, because Hussein is in America, he has dollars in his hands and he's traveling to the UK. Each code is also made up of two figures. A lower figure on the left, we call that the bid price, and the higher figure on the right, and we call that the offer price. The relevant side depends on whether the client at the kiosk is buying or selling that particular currency. So usually the exchange house or the bank, whether they're buying, they offer you the price on the left, the bid, or if they are selling, they offer you the price on the right, or the offer price, sometimes called the ask price. Given that the following code is the one highlighted by the assistant at the kiosk, how many pounds will Hussein get, assuming he has $1,000 on him? So obviously, since he has dollars and he wants pounds, and the kiosk is offering him the bid price and the ask price. So which of the following two prices will he get, assuming that he is selling his $1,000? That means the kiosk is buying dollars. The kiosk is buying dollars from him and they are selling him pounds. How has the two sides of a foreign exchange quote are applied is logical. So the left-hand side is the number of UK pounds handed over for each dollar transaction. The right, we call that the bid price. The right-hand side is the number of UK pounds required for the kiosk to hand over a US dollar, the offer price. So looking at 0.74 to 0.8, so 0.74 was the bid, 0.8 was the offer, knowing that the quotes are the amounts of UK pounds to dollar, a US dollar will buy 0.74 pound and 0.8 is required to buy a single US dollar. If it were the other way around, clients at the kiosk could use a dollar to buy 0.8 pounds, or it would require 0.74 pounds to buy back the US dollar, leaving the client with a guaranteed profit of 0.06. That would be fantastic for the client, obviously, since the client will be making the profit, but the foreign exchange kiosk is trying to make money, not lose it. Thereby, the 0.06 is effectively the margin or the spread that the kiosk makes. So if you are making this transaction, you should always think from the kiosk point of view, from the exchange house's point of view. Let's go back and investigate the relationship between these two sets of codes. Remember, for every £1, the exchange house will buy $1.25 or will sell $1.35 to you. For every $1, the exchange house will buy 0.74 pounds from you, and they will sell 0.80 pounds to you. There is a mathematical relationship between these two codes. The left-hand side of the first code represents the number of US dollars per UK pound. If it's flipped, by dividing it by 1, it reveals 0.80. The same number appears on the right-hand side of the second code. The same is true when the right-hand side of the first code is flipped by dividing it by 1. So 1 divided by 1.35 gives you 0.74. So what we're trying to say here is 1 divided by 1.25 gives me this. 1 divided by 1.35 gives me this. This gives the same number on the left side of the second code. So why was it flipped? Well, it's because the currency was flipped. Here, we were looking at how many dollars every pound will get us. Here, we're looking at how many pounds every dollar will get us. This is all logical. The number of US dollars a UK pound will buy, 1.25. The number of US dollars a UK pound will buy is 1.25. Should be based on the same number of UK pounds that are required to buy a dollar, flipping it to 0.80. Because remember, in the first cases they are buying. In the second cases, since the currency has flipped, they are selling. Similarly, the number of US dollars that will buy a UK pound are 1.64. So you need $1.64 to get 1 pound sterling. It should be based on the same rate as the UK pounds that are received in exchange for a dollar. So if you have $1, you are going to get 0.74 pounds. The more significant portion of the foreign exchange market is the result of transactions by companies rather than individuals, particularly banks, particularly international banks, which we sometimes called cross-border banks. The foreign exchange market is huge. It's the biggest in the world. It's the largest financial market in the world. With the most recent survey of activity showing an average of 5.1 trillion per day. With this total, the major currencies that are involved in the transactions are the US dollar, around 44%, the euro, the yen, and the pound sterling. The most popularly traded pair are the US dollar and the euro, with around 24% in total. Now let's look at an example of how companies use the foreign exchange market. So let's look at a company called Pogo. CISI is very creative in its naming examples. So Pogo, I'm not going to say that name, I'm just going to say Pogo. Pogo is a US company that manufactures and sells pogo sticks. With pogo sticks becoming increasingly popular with children, Pogo has just received a large order for pogo sticks from a large European retailer. It is the first order that the company has ever received outside the US. And the European retailer is demanding that the price is agreed in euros, not US dollar, because they can only pay in euros. So Pogo, the company, is going to create pogo sticks, manufacture them, ship them to Europe, receive euro for them. Even though they are an American company and their costs are in dollars and they are shipping in dollars, they are going to receive payment in euro. That happens all the time. When the money is received by Pogo, it will be in euros, requiring Pogo to enter into a foreign exchange transaction to convert these euros that it has received into dollars, selling the euros in exchange for the US dollars. Now, the foreign currency transaction that Pogo requires will be a currency trade that involves selling euros. They are going to sell euros. Why? Because that's what they are going to be receiving from their clients. Their client in Europe is going to pay them euros. Okay, fine. Now I have euros in my hand. I don't really have any use for euros. I'm an American company. So this euros I have in my hand, I need to sell them and get dollars in return. So they are going to sell euros and they are going to buy dollars. Now, there is a danger that Pogo will not receive as many dollars as it hoped when the sale was agreed, because currencies, prices change all the time. Because the exchange rate between the euro and the dollar changes. The exchange rate for all currency changes all the time. However, the opposite could occur, and Pogo might end up being in the position of receiving more dollars than it had hoped for, because the exchange rate has moved in their favor. These foreign currency trades are very common as a result of all international business that takes place around the world. They are generally done with the banks. So in the above examples, it would be Pogo banks that will receive the euros, convert them to dollars at the appropriate exchange rate at the date of receipt, which they might not know, which might be in their favor, thereby getting them more dollars, or not in their favor, getting them less dollars. Remember, they want dollars because they're an American company. So that ends our foreign exchange section. Let's look at insurance. The concept of insurance is pretty straightforward. It is to put in place a safety net just in case something unfortunate happens. For example, most countries require individuals that are driving cars to be insured. So if the driver is involved in a crash and is at fault, the insurance policy will be used to cover the cost of the crash, such as repairing the damage to the other car. Car insurance. Remember, when we talked about insurance in the previous chapters, we said insurance in general is divided into two types. You've got general insurance and you've got life insurance. So life insurance is a certain amount is paid when death happens. Any other type of insurance that is not life is considered to be general insurance. The insurance policy is provided by an insurance company in exchange for a payment. We call that a premium. And that premium changes. It changes depending on the type of car, depending on the driver, who the driver is, depending on the history of the driver, and depending on the country. Premiums are calculated mathematically. We call that actuarial insurance. Calculates the premium depending on the background of the insurance holder and the asset that is being insured, and of course on the history. If this is a driver who has a history of having accidents all the time, he's gonna pay a lot of premium because the chances of him having an accident again is very high, thereby causing the insurance a lot of money. Mac Radcliffe has just purchased a new car. He knows he needs to be insured and searches the internet for possible insurers. He finds that Draxa, obviously this is a copy from AXA, Draxa is offering insurance for a very competitive premium of just $80 per month. Mac takes up the policy and begins to enjoy driving his new car. Mac is referred to as the insured, and he has entered into an insurance policy with Draxa as the insurer. Draxa is the insurer, or the insurance company. The $80 monthly payment from Mac to Draxa is the insurance premium. The above example relates to personal insurance because the insurance is being provided for an individual for their personal situation. There are many possible forms of personal insurance, such as insurance against the risk of theft from your house, so you insure your contents, and the insurance against the risk of sickness, medical insurance, the insurance in case of fire, for example, insurance against a flood. However, it is not only individuals that might find it useful or helpful to have insurance as a safety net. Imagine some small company, so you can have business insurance. Imagine a small company that runs a general store. A fire or a flood could destroy most of the goods it holds for sale. So insurance can be taken for businesses also. That covers companies' risks, and these are known as corporate insurance. We saw in Chapter 2 how insurance companies might reduce the risk that they face by insuring large risks using reinsurance. Essentially, reinsurance is an insurer taking out insurance against the possibility of a claim, against the policy they have insured. Another possibility for the larger risk is that insurers each take a share of the risk using syndication. So syndication is spreading the insurance against multiple insurers, against a group of insurers. So if you can't afford, as an insurance company, if you can't afford to insure a certain risk fully, you might ask other insurers to step in. Here's an example. Total Shipping is a shipping company that has 100 container ships that move goods around the world. Each ship is worth around $100 million. That's a lot of money. So Total Shipping is looking for insurance against the risk that any of these ships suffer damage through fire, adverse weather, mechanical fault, or hijacking. These were the 4 risks that the shipping sector faces. Due to the size of the potential claim, if something were to go wrong, it is tempting to think that the insurer for TS would need to be absolutely huge. Since 100 container ships, that means what? $1 billion, $10 billion. That's the value of the ships. However, in reality, the insurance will be provided by a group of insurers rather than just one insurance company. This group of insurers forms a syndicate. Syndicate is another meaning for group. And each participant agrees to receive a set proportion of the insurance premium and bear an agreed proportion of any claim. If there were 5 participants that agreed to share the premium and the risk equally, they would each get 20% of the premium and bear 20% of the claim. That's what a syndicate is. So if the premium for this insurance is $10 million, and this is distributed across 5 insurance companies, Company A, Company B, C, D, and E, each of them will get $2 million of that premium, and they will have to cover 20% of the risks, which sounds fair. Now, whether or not $2 million or $10 million is a fair amount, that's a different thing. So this is an example illustrated as a chart. As the example makes clear, syndication is the grouping of insurers to enable them to underwrite, cover substantial risks such as those from Total Shipping. So you notice that Total Shipping, this is the risk, and the risk has been spread across insurance company 1, 2, 3, 4, 5, each of them bearing 20% of the risk and getting 20% of the premium. Now, the effect of syndication is to spread the risk around the insurance companies, which enables the insurance industry to take on insurance for even the largest, most expensive risks, including damages caused by leaks from oil rigs or airline crashes and the like. Because if these risks are covered by a single insurance, they will very well cause the insurance company to go bankrupt. That's why for a huge amount of risks, the insurance companies will spread them across a syndicate. That means that they will also have to share the premium they receive, and that's fine, because in the event any of these risks happen, that insurance company might go bankrupt. The final section in this chapter is financial planning. So no need to take any more breaks. We can just finish with this section and then end the day. Financial planning is a professional service available to individuals, their families, and businesses who need objective assistance in organizing their financial affairs to achieve their financial and lifestyle objectives more easily. And since different individuals and families and businesses have different financial affairs, different financial and lifestyle objectives, a good financial planner is somebody who is able to customize a financial plan to that individual family or business. Financial planning is clearly about financial matters, so it deals with money, assets that have monetary value. It also deals with debt, obviously. It deals with liabilities. Invariably, this will involve looking at the current value of a client's bank balances, any loans, investments, and other assets that the client has. It also is about planning, defining, quantifying, and qualifying goals and objectives, and then working out how these goals and objectives can be achieved. So what is your objective? Retiring early? Paying for college for my children? Buying a house? Getting married? And then they will quantify, they will tell you how these goals can be achieved and how we can work towards achieving them. In order to do this, it is vital that the client's current financial status is known in detail. So we need to understand the client's background before we can advise them further. Financial planning is ultimately about meeting a client's financial and lifestyle objectives, not the advisor's objectives. So obviously the advisor's objectives are to earn as high fees or as high commissions as they can. But that's not what financial planning is all about. It's about planning the client objectives and meeting them. Any advice should be relevant to the goals and objectives agreed. Now, of course, financial planning the financial planner should earn a living. But the financial planners, and this is a big area of contention, because financial planners sometimes do not act in the client's best interest. They act in their own best interest, and this is illegal and it's unethical. In many countries around the world, there are strict requirements on how financial planners and advisors should act. They should be always acting in the client's best interest. They should always avoid conflicts of interest with the client. They should make sure that their advice is suitable. They should make sure that their reports are proper and timely and punctual. In other CISI qualifications, particularly in the ICWIM qualification, the Certificate in Wealth and Investment Management, there is a whole chapter dedicated to this relationship between an advisor or a financial planner and their client. And we call that fiduciary duties. Fiduciary means trust. The client places their trust with the financial planner, with the financial advisor, who has a responsibility to not abuse that trust, to not take advantage of it in their own interest. Financial planning plays a significant role in helping individuals get the most out of their money. Careful planning can help individuals define their goals and objectives. That's why whenever you speak with a financial planner, they will give you a questionnaire, sometimes multiple pages, that asks you everything about your personal life, your personal and professional life. And they need to work out how these may be achieved in the future using available resources. Because not everybody is the same. Sometimes you might have some lofty goals, but your income might not, or your assets might not allow that. So the financial planner should work around this limitation. There will always be limitations. We call these constraints. Sometimes investors, clients might come to you with some big objectives, and then they would say, well, please only invest in Sharia assets. That's a limitation. Or please only invest in in our local market. That's also a limitation. Financial planning can look at all aspects of individuals' financial situation and may include tax planning. This is something that we might not look at in the Middle East, but it's very big in the West. Both during lifetime and on death, because you do pay tax when you die, and that's called inheritance tax. Estate tax. That's why we call part of tax planning is also estate planning. How can you leave as much as possible for your family when you die? Asset management, debt management, retirement planning, personal risk management, which means protecting your income and your capital in the event of an illness. And if you die, providing for your dependents when you die. Sadly, financial planning is not very popular in the Middle East. It should be, but it's not. The CISI offers qualifications and related products at all levels for those working in or those looking to work in financial planning. Actually, CISI has qualifications in many aspects, in risk management, Islamic finance, capital markets, financial planning, and wealth management, but they're mostly known for financial planning and wealth management. You can find more information on CISI's website. A vital or very important subset of financial planning is retirement or pension. Planning your pensions or your retirement. And it is this that is specifically mentioned in the syllabus of this qualification. And retirement planning forms a part of most CISI qualifications. Any qualification that talks about investments and finance, you will have a chapter that covers retirement planning. Usually it goes hand in hand with insurance in that chapter. As healthcare standards improve, medical advances continue, most of us will be lucky enough to live longer than our parents and grandparents. However, do we want and expect to continue working until we die? The answer to this for most of us is no, because there will come a time before you die that you would wish to stop working and have some peace, have some rest for the rest of your life. You've worked for 40 years, sometimes 50. You just want to spend the rest of your life, whatever, how many years you have, 10, 15, 20 years, you want to spend them resting. Those of us expected to enjoy a lengthy retirement must recognize that this will need to be funded in some way. Now, the last 10 or 20 years of your life, you're not going to be working. You'll be retired. How are you going to fund that retirement? You still have to pay bills. You still have to put food on the table. Putting money away to use in retirement is called retirement planning, starting to save. And the earlier you start, the better. We're not saying that you should have to start early. I mean, you can start at any time. If you haven't started planning now is the great time to start. But you should have a plan for your retirement. The money earmarked or put aside for retirement is often termed a pension. And there are 3 potential sources of pension. Let's see them. So you can have a pension by your government. You can have a pension given by a company. And you can have a pension that you can have by yourself, individual. The most obvious source of pension to cover individuals' financial needs is to put money away in a personal pension scheme. And this is most likely if you have no state pension, and if you are, let's say, self-employed. So you are not working as an employee, so your company does not provide you with a corporate pension. So if you don't have a state pension and you are self-employed, you will have to go for individual pensions. These schemes typically are made available by banks, insurance companies, and fund managers. They generally involve the individual putting aside their monthly salary, part of their monthly salary, into a pension scheme, which the pension scheme then invests in various shares, bonds, and financial assets. So you pay a premium every month, and the insurance company takes that premium, invests it in the fund. The expectation is that contributions into the scheme plus the potential growth in those investments will provide the individual with enough money for a relaxed retirement. Now, before we continue, problems with individual pension is that they are expensive. Just like everything individual related, they are expensive. Same thing for medical insurance. If you're working in a company and your company is paying for your medical, the company is paying, let's say, $1,000 a year on your medical. If you start your own company and you want to pay your personal medical, it's going to be double, probably $2,000. A personal insurance, personal pension are expensive. Problem with state pension is that it's the longer life expectancy of individuals. So every month the government will take part of your salary. They expect you to retire at 65. They expect you to die at 80 or 75. Turns out you're lucky, you live until you're 100. So the government has 20 extra years to pay for your pension. They were not expecting you to live that long. So the longer we live, the more pressure that puts on state pensions. And many state pensions around the world are in deficit. It's a problem. Then you have employer pension. And this is a pension offered by companies. And there are two types. Now, what we are writing on the screen here are outside this qualification, usually, unless we cover them in the next few pages. So under the employer pensions, you've got the defined benefit and the defined contribution schemes. In other CISI qualifications, you will learn these in more details. So the defined benefit is calculated based on your annual salary and number of years. And the employer funds the scheme. That means the employer pays for it. And because it depends on the employer and it's usually expensive, companies around the world have started to move away from the defined benefit scheme. It's too expensive for them. Most companies around the world are now using defined contribution, whereas the employee pays or funds. It's taken out of their monthly salary and it's invested. So let me just clear that. And the amount that the employee pays every month is invested in the stock market. So with the defined contribution scheme, you don't really know how much you're going to earn when you retire because it all depends on the performance of the stock market. But usually in 20-30 years, stock markets always go up. They always have these short-term dips, what we call dips or retractions, but in the long term, stock markets does very well. Now, clearly, the more money that is invested and the earlier it is invested, the more comfortable the retirement will be. The more money that is invested, you'll have more cushion, and the earlier because of compounding, so you will have compounded more, the more comfortable the retirement will be. It is also common for the firm that an individual works for to provide a pension scheme. Companies sometimes provide pension scheme. This may attract good quality staff as well as encourage them to stay. These employer pension schemes can be paid for completely by the firm. An example of that is the defined benefit. Full funded scheme based on your final salary, or might require the employee to contribute a proportion to contributory scheme. An example of that is the defined contribution. A number of countries around the world will provide a pension to their citizens in their retirement years. These are known as state schemes provided by the governments. However, these schemes are generally insufficient to fund what most of us would describe as a comfortable retirement. State pension is usually very, very small. The state scheme will need to be supplemented if anything more than a very basic level of retirement income is expected. Because usually it won't be enough for you to live normally, to continue the same lifestyle that you have. That's why if you have a state pension, that is when government is giving you a pension, that's very good, but that's not enough. You need to either look at corporate pension if you get from your company or personal pension. Let's look at a quick example. Mr. Average is 48 years old. He is employed. His employer does not provide a pension, and he has not set up a personal pension scheme. His children have grown up and left the family home, and he's beginning to think about his retirement. Suddenly he's waking up. His earnings currently are £500 per week. Now, Mr. Average uses the internet to discover how much state pension he can expect when he retires. He is shocked to find that the maximum he can expect is less than a quarter of his earnings, just £100 per week, as a state pension retirement. He's worried. Despite the fact that life may be cheaper in retirement, you don't have all of these expenses to pay, just your simple house with your wife. He will not have to travel to and from work and should have paid off his mortgage. The expenses are a lot lower. He does not think that he will be able to make ends meet. He immediately sets up a meeting with a financial advisor to discuss setting up a personal pension scheme. The above example of Mr. Average actually uses the UK's 2018 average level of earnings, £569 per week, and the UK's maximum state pension of £130 per week. And that's now. Mr. Average will probably struggle to build up a potential personal pensions as he is starting so late in life. The longer pension money is invested for, the more opportunity it has to grow. He should have started his retirement planning earlier to fund the shortfall between the amount of money he will receive and the amount of income that will enable him to enjoy life. So now, if he's 15 years away or 20 years away from retiring, so that's technically shorter than if he had started in his 20s, he would have 40 years. But then again, better start now than never, right? As mentioned earlier, people are generally living longer due to medical, nutritional, and social advances. And this increase in life expectancy has a serious impact on pension provision. This problem is typically referred to as the longevity issue. As people live longer, how will their needs for a larger amount to provide them with a pension be financed? Let's look at a quick example. In America, this is the life expectancy. In the 60s, it was almost 70 years old. In 2015, it's almost 79 years old. The World Bank data shows that those born in 1960 have a life expectancy of almost 70 years, and those born in 2015 can expect to live until they're almost 80. This has ramifications for pensions. An individual born in the 60s and retiring at 65 will only need a 5-year pension. Why? Because he's expected to live until he's 70. So we only need to cover our expenses for 5 years. But this requirement increases to almost 14 years for individually born in 2015. Because if they're going to retire at 65 and they have a life expectancy of 79 years, you have to fund this 14 years of retirement. Whereas here, you have to fund only 5 years of retirement. As individuals live longer, the funding required for the same level of pension increases. If the pension is a personal pension, the solution is to pay more into the pension, save more, work for more years, and retire later, or do both. Combine greater contributions with the later retirement date. If it's an employer-sponsored scheme, the employer might be willing to pay more into the pension, but the impact this will have on the employer's profitability may mean that it needs to be combined with the later retirement date. So the employer will say, fine, I'll contribute more towards your pension, but you're not going to retire at 65. You'll have to retire at 68. For the state, a longer life simply means more money is required, which will mean higher taxes will need to be collected from the working population to pay for the pensioners who are living longer. In summary, the importance of retirement planning is that an individual wants to enjoy a comfortable retirement. It is vital to put money in some sort of pension scheme. What sort of pension scheme? Study what's been available, what's being sold in your market, but be very careful before you get into anything. Pension schemes and insurance are a very popular way for you to be cheated by financial companies. So understand the terms and the conditions and take a pension scheme. It's a very good way for you to plan for your future. Or open a portfolio and then invest in it. Generally, it is sensible to start contributing to a pension earlier than later to take advantage of the potential growth, and we mean here the compounding, and the value of the investments made. However, the reality for many people is that it is only after some years in work that earnings have increased sufficiently to enable them to save for a pension. So if you say to anybody in their 20s, you should save for your pension, he's going to laugh and say, do you know how much I earn? I can't even cover my own expenses. I can't even save. I'm in debt in most time. How can I save for my retirement? And that's the problem. Very few people at the very beginning, at the very early stages, will have enough money to save. They will only have enough money to start saving once they are mid-career, which means they are now closer to their retirement.